Hi everyone and welcome to chapter 19. This is an important chapter and very interesting. In this chapter we are going to discuss about working capital management. So let's start. So chapter outline, we are going to discuss overview of working capital, what constitutes working capital. We are going to discuss what is trade credit, how to manage your receivables, how to manage your payables, how inventory management takes place, and how to do cash management. The learning objectives that the chapter covers is understanding the cash cycle of a firm and why managing working capital is important. Use trade credit to firm's advantage. Make decisions on extending the credit and adjusting the credit terms. Manage account payables. Contrast the different instruments available to a financial manager for investing cash balances. The main components of so before we proceed, let's open an Excel too so that we can discuss a bit. So the whole chapter is about working capital. Okay. Now what is working capital? Working capital consists of current assets minus subtracted by current liabilities. Now what constitutes current assets? Now current assets are generally cash, inventories and receivables. What constitute current liabilities? Current liabilities are accounts payable. So let's understand what are these components. What is cash? Cash is the liquid money that you have either in cash form or in investments that can be converted into cash. So that is cash and cash equivalents that the firm has, which are part of current assets. Then what are inventories? Inventories are the total amount of product you have with you to sell. So it is, for example, for a company that is manufacturing toys, all the toys that it has not sold, it is lying in its warehouses, are its inventories. What are receivables? Receivables are amount of money that is due from your customers. So it's a toy company, so it may be selling toys on credit. So the amount that it has to receive from its customer is receivables. Then what is account payable? Account payable is the amount that is due to your suppliers. So it is manufacturing toys, mostly it will be buying those toys from China. So whatever credit that is extended by these Chinese manufacturers to our company, that is account payable. So main components of net working capital are cash, inventories, receivables and account payable. So this chapter is managing all of these components. There is one more component, that is current liabilities, that is liabilities that are due, which are not discussed, but it also is a part of liabilities. So liability means short-term loans that are due. So let's discuss these things. So first important thing is, before we go to managing working capital, you need to understand what is an operating cycle and what is a cash cycle. So let's discuss. So we are discussing a toy company. So let's say it buys toys from China. Okay, it buys toys from China at this point. Okay, then this is where it pays for those toys. Let's say it is after 15 days. So they extend the credit period for 15 days. Okay, then it repackages them. Okay, so creating inventories. So let's say it takes 15 days for it to get the toys, repackage them into Canadian products, and so buys from China. So it is purchasing here, it is paying for purchases, then converting to inventories, and then selling to customer. Okay, so let's say converting to inventories take 15 days, selling to customer, the sales cycle inventories are there for 15 days again. Okay, and then customer is given a credit of 7 days, so customer pays. Okay, so let's say this is 7 days. So what is happening? A Canadian company, a toy company, buys product from China. It takes 15 days for it gets 15 days to pay for those products. Then it takes 15 days for them to arrive and repackage, that is convert to inventory. It takes 15 days to sell to customer, and after 7 days the customer pays. So the whole cycle, right from initiating the purchase order to the customer selling, the customer paying, the whole cycle, this whole cycle is called as operating cycle. This whole cycle is called as operating cycle. Okay, starting from the purchase order finally to the moment the customer pays. Now what is cash cycle? Cash cycle is when the payment for purchases happen and when the customer pays. So cash in means cash goes out for purchases, cash comes in for customers. So this is called as, I'll color code it differently, this is called as cash cycle. So once again, what is the operating cycle? It's the whole cycle. So right from putting a purchase order right to getting the customer paying for it. And what is the cash cycle? Paying for those purchase orders and customers paying for it. Now sometimes this cash cycle can be negative. When it will be negative? When the customer pays for the order before you have to pay suppliers. Okay, so if customer is prepaying, let's say Tesla's new product is getting launched, Cybertruck. Tesla already has like hundreds and thousands of orders for that Cybertruck. So customers are already paid for that Cybertruck which it hasn't even produced. So in that case, the cash cycle will be negative because the customer is paying first and then it is getting produced. So in such cases, the cash cycle can be negative, but generally it is positive. So let's discuss. The average length of time between when firm originally purchases its inventory and when it receives the cash back from selling its product. The whole cycle is called as operating cycle. What is the cash cycle? The length of time between when the firm pays cash to purchase its inventory and when it receives cash from sale of output from that inventory. So paying to suppliers and getting paid from customers, the difference in that. How is cash cycle computed? Cash cycle is generally computed by using this formula: inventory days plus average receivable days minus average payable days. So I'll write it down in Excel. Inventory days, cash cycle, we are computing cash cycle. inventory days plus receivable days minus payable days. Now how are inventory days computed? Inventory days are computed by using the formula inventory, the total inventory that you have, divided by average COGS, cost of goods sold. So whatever is the cost, you average it. Average means divide by 365. Okay. Then account receivable days are calculated as account receivables divided by average sales, average daily sales. This is average daily, that's why you divide COGS by total COGS in the year by 365. Account receivable by average daily sales, and account payable by average daily sales. Sorry, account payable should be divided by average daily COGS. Payables are always cost. So how is cash cycle computed? It is inventory days plus receivable days minus payable days. How is inventory days computed? It is total inventory divided by average daily COGS. Whatever COGS you have, you first divide it by 365 and then use this formula. Then account receivable days is computed by account receivable divided by average daily sales, and payable days is computed by account payables divided by average daily COGS. Okay, so let's use that formula to compute it. The following information is from Loblaws 2013 income statement and balance sheet. Numbers are in millions. Use it to compute Loblaws cash conversion cycle. So sales is given, COGS is given. So how do you compute average daily sales? Divide this by 365. How do you compute average daily COGS? Divide this by 365. Account receivable is known, inventory is known, and payable is known. So cash conversion cycle is defined as inventory days plus account receivable days minus account payable days. Thus we need to compute each of these three ratios in cash conversion cycle. In order to do that, we need to convert sales and COGS into daily averages, which we do by dividing it by 365. So average daily sales, total sales divided by 365, average daily COGS, total COGS divided by 365. Now inventory days are calculated as inventory divided by average daily COGS. So total inventory given divided by average daily COGS, so 30.80. Average receivable days is average receivables divided by average daily sales. So our total receivables divided by average daily sales, so 6.97. Average payables are account payable divided by average daily cost of goods sold, so that is 3797 divided by 67.66, that is 56. So Loblaws is 30 days of inventory, 6 days of account receivable minus 56 days of account payable, so it comes to negative. So what does this negative indicate? That Loblaws is actually getting paid first and then it is paying its suppliers, and that is evident because the suppliers are extending credit for 56 days while the customers are paying only in 7 days. Customers only take 1 week to pay, but it gets around 56 days to pay its suppliers. So Loblaws actually has a negative cash conversion cycle, meaning that it generally receives cash for its goods before it pays its suppliers. Loblaws is able to do this because it sells directly to the consumer, so it charges your credit card or receives cash as soon as you make a purchase. The result is relatively low receivable balance. At the same time, Loblaws suppliers allow it to wait for 56 days before paying them. This more than often offset the number of days capital is tied up in inventory and in receivables. Now, is there any point of managing your working capital efficiently? So there is a point. We have seen, like, a firm is valued by discounting its future cash flows. A firm's value today is discounted future cash flows. Now, cash improves, the cash balance improves if you manage your working capital, because if you have a lot of working capital, your cash is invested in that working capital, you cannot use it. So when you reduce your working capital, that is, you manage it efficiently, the cash frees up. So that freed up cash improves your valuation. So any reduction in working capital requirements generates a positive free cash flow that the firm can distribute immediately to its shareholders. So projected net income and free cash flows next years for River City Plain are given in the following. So we have discussed this. Net income is given, we can compute free cash flows. Net income plus depreciation minus capital expenditure minus increase in working capital gives free cash flow. Now, if you can reduce this working capital, the free cash flow goes up. If you reduce working capital, free cash flow goes up. Now, River City expects the capital expenditure and depreciation to continue to offset each other, and for both net income and increase in working capital to grow at 4%. The River's capital cost is 12%. If River City were able to reduce its annual working capital by 20% by managing its working capital more effectively without adversely affecting any point of business, what would be effect on firm's value? So a 20% decrease in required working capital increase would reduce the starting point from so what will happen? So if it is managing its working capital effectively, instead of spending $1 million, right, on working capital, it can spend only $800,000. So it is freeing up $200,000 worth of cash. The working capital increase would still grow at 4%, but increase would be 20% smaller. So effectively what is happening? We know present value of a firm is cash flow divided by R minus G. We can compute the cash flows: net income plus depreciation minus capital expenditure minus increase in working capital. In first case, 20 million was its net income, depreciation 5 million, capital expenditure 5 million, working capital was 1 million. So divided by R minus G, R is 12%, growth rate is 4%. So you get $37 million as the firm value. If they manage their working capital more efficiently, the value becomes, instead of 1 million, now you have to spend 800,000. So your firm value increases much more than 37. So it comes to 240. So it's not actually 240. So let's compute that, because I think they have made a mistake. It was 20 million plus 5 million minus 5 million minus 0.8 million. So the 19.2 divided by 12% minus 4%. So 240 million in the first case. In the second case, let's compute it in the first case too. 20 plus 5 minus 5, but now here you are spending 1 million. So this divided by 12% minus 4%. So it's 223, not 237.5, not 37.5. So your value has actually gone up. The firm's value has gone up by 2.5 million. Okay. So although the change will not affect River City's earnings, net income, it will increase the free cash flow available to the shareholders, increasing the value of the firm by 2.5 million. Next is trade credit. So what is trade credit? The difference between receivables and payables, that is the net amount of firm's capital consumed as the result of those trade credit transactions. The credit that the firm extends to its customers. So what is trade credit? So I'll explain it. So suppliers extend you some credit, okay, and customers, you have to give some credit. So difference between these two credit is trade credit. Now, how would you ideally want to function? How would you ideally want your firm to function? You want your suppliers to extend maximum credit and you want your customers to pay sooner, right? You don't want to extend credit to your customers, because when suppliers extend you credit, they give you money to use, right? When you have to extend credit to customers, you provide money, you finance your customers. You don't want to do that. So you want to pay your suppliers later, as late as possible, and you want your customers to pay as soon as possible. Now suppliers know that. Suppliers know that you want to pay them as late as possible. So they will generally give you discounts if you pay faster. Same way, you want your customers to pay as soon as possible. So you may have to give out certain discounts to your customers. Now we'll see what is the impact of these discounts on decision making. So credit terms are generally mentioned as 2/10 net 30. What does this mean? 2/10 net 30. This would be the credit that is extended to you by your supplier. So what does that mean? So it means you get a 2% discount if you pay in 10 days, else you pay 100% on 30th day, on or before 30th day. So if you pay within 10 days of your purchase, you get a 2% cash discount, right? If you do not do that, then between 10 to 30th day, the next 20 days, you have to pay 100%. Okay. Now ideally, if this is the case, if you're planning to take discount, you should always pay on the 10th day, so that you can delay your payments, right, up to the maximum extent. If you're not planning to take discount, you should always pay on the 30th day. Okay. Now let us say someone gives you this credit 115 net 45. What does that mean? That you get 1% discount to pay within 15 days if you pay within 15 days, or you have to pay 100% of the amount up to 45 days. So let's go back. So a cash discount of 2% is given. In this example, a 2% cash discount is taken if paid during the discount period. Discount period is 10 days and the total credit period is 30 days. So purchase is made $100. If you pay within this period, you pay only 98 bucks. If you pay after this, you pay entire 100 bucks. So what is the cost of credit? So we have discussed that when supplier gives you credit, he is financing you. And when you give credit to customers, you're financing them. So there should be a percentage that you are getting financed for. So how to calculate that percentage? So that is what we are going to discuss. So cost of credit is calculated as EAR, effective annual rate, 1 plus R to the power n minus 1. So cost of credit is calculated as 1 plus rate of return, right, to the power to the power n minus 1. 1 plus rate of return r to the power n is the period, minus 1. So let's do an example and try and understand it. Your firm purchases goods from its suppliers on a term of 115 net 40. What does this mean? That you get a 1% discount for the next 15 days, or after which you get the total credit period is 40 and you pay 100% if you do not pay it. So how is it structured? So let's say 15 days and total credit period is 40 days. So 40 minus 15, so 25. So total is 40. So if you pay before 15 days, you get 1% discount, so you only pay 99. If you pay within 15th to 25th day, right, means 25 days beyond 15th day, you pay 100%. So that is the terms that are extended to you. So they want you to calculate what is the total cost. So how to do that? So using a $100 purchase, for example, you get a 1% discount if you pay within 15 days, or you pay the full amount within 40 days. 1% is $1 discount. So you either pay $99 in 15 days or $100 on the 40th day. The difference is 25 days. We have discussed that. So from 15th day up to 40th day, you get 25 days to pay 100%. The EAR is calculated as, so EAR needs 1 plus rate of interest and n. So how to do that? So EAR is calculated as, what is rate of interest? R, to put it in the formula. So R is computed as equals to discount given, so I'll write down the formula, discount given divided by price after discount. Discount given divided by price after discount. So what is discount given? $1. What is price after discount? 99. So R is 1.01. So R to use in the formula is 1.01. Now we need N. Okay. So how do we compute N? So N is computed as 365 number of days divided by 25. Okay. Where did I get 25 from? So 25 is always, what is net amount? This is always net amount minus discount, net period minus discount period. So you were given a discount period of 15, right? The net was 40. So this number of days N is computed as 365 divided by 25. Where does this 25 come from? It is net amount minus discount period. So you compute it 1 plus, so let's do that here instead of looking at it. So it is 1 plus R to the power 14.6 minus 1. So you are being financed at a rate of 15.80%. You are being financed at a rate of 15.80%. So effectively you are borrowing from your supplier at 15.80%. So if you need to take the full 40 days to produce the cash to pay, you would be better off borrowing $99 from the bank at a lower rate and taking advantage of the discount. So if you do not take the discount, you are paying a penalty of 15.80% annualized. Trade credits and market frictions. Benefit of trade credit. it is simple and convenient to use, and it has lower transaction cost than alternative sources of funds. It is more flexible source of funds and can be used when needed, and it is sometimes the only source available to the firm. So we have seen that you're almost paying 15% rate of return to finance from your suppliers, but it is sometimes still beneficial to take it because it is easy and convenient. You do not need to go through the credit checks, you do not need to borrow funds from the banks, right? So it is sometimes beneficial to take trade credit. Trade credit versus standard loans. Firms offer trade credit because providing financing at below market rate is an indirect way to lower prices for certain customers. So sometimes if supplier really likes you and likes you as a customer, then he may give out trade credit at below market rates. The supplier may have ongoing business relationship with its customers. It may have more information about the credit quality of the customer than a traditional outside lender such as bank would have. If the supplier defaults, the supplier may be able to seize the inventory as collateral. So he is in a better position than a bank. Okay. Now the other side of credit is the credit that you extend to your consumers. So the credit that you extend to the consumers is collection float, disbursement float, and electronic check processing. So the time it takes for your customer to pay you composes of maybe he pays you but the check hasn't arrived, that is mailing float. Then you get the check but your department takes time to process it, that is processing float. And availability float is you put it in the bank but bank takes time to pay you. So that also is a factor that you need to counter in. So how to improve the collection float? Improve internally. Take less time to mail, maybe use electronic transfers, right? Take less time to process those electronic transfers in your accounting department, and have good relationship with banks so that they process your payments faster. Disbursement float is sometimes the bank takes time for it to credit your amount, and electronic check processing can improve this float. Now, determining credit policy. So whenever you extend credit to your customers, so that involves determining the credit policy in 3 steps. Establishing credit standards. So what are the terms on which you're going to lend, right? Establishing credit terms, and finally establishing a collection policy. So let's see what it entails. So determining credit policy, there are 5 C's of credit. So whenever you decide to give credit to any consumer, you have to look at 5 things. The character of the consumer, whether he will pay or not, right? Capacity of paying, right? Capital that the consumer has, what is the net worth of the consumer, collaterals that the consumer can keep, right, on lieu of paying, and conditions in the overall market, right? What is the economic conditions, what is the unemployment rate, and all those things. So based on that, you will determine your credit policy. So your company currently sells its product with a 1% discount to consumer who pay cash immediately. Otherwise, the full price is due within 30 days. Half of your customers take advantage of this discount. You're wondering dropping the discount so that new terms would be net 30. So you're getting rid of that discount so that everyone buys on credit and they pay in 30 days. If you do not expect to lose some customers who were only willing to pay the discounted price, but the rest will simply switch to taking credit. So you are expected to lose some customers because some may like only to pay in cash, they do not like credit. Although you estimate that you will sell 20 fewer units per month because some customers will not buy from you, compared to 500 currently, your variable cost is 60 and your price is $100. if your required rate return is 1% per month, would you switch your policy? So how do you decide that? So what is happening? You currently give 1% discount to your consumers who pay on time, right? So instead of $100 product, you sell it at 99, right? If they pay in cash. So you want to get rid of this cash payment option. So everyone takes credit from you, right? So because of that, so you will lose out on some customers. So you want to calculate, does it make sense to do that? So to decide whether to change your policy, we compute the net present value of the change. It cost you $30,000 to make 500 units, 500 into 600 cost per unit. You receive payment for half of the units immediately at 99 bucks, 1% discount. Another half comes in 30 days at a price of 100 bucks. At that point, you're starting over again with the next set of product. So you think your cash flows in any 30 days period. So if you're extending credit, how would your cash flow look like? So you produced 500 units at $60 a piece. So you spend $30,000, but customers pay 50% customers pay right away. So 250 into 99, so 24,750 pay right away. So in total, you're spending 5250 to start the process. Now here on, each time customer will pay 25,000, right, at $100 a piece, and 24,750 at $99 a piece, because these are customers that have bought product here who are paying now, and these are customers who are paying in cash. And each time you produced 500 units at 60 pieces per unit, so $60 per unit. So in total your cash flow is 25,000 positive and 5250 negative. So you can, same way, if you get rid of this policy, what will happen? Everyone takes credit. So you spend 28,800 right now, but 28,800, 480 units, 20 units less sold into $60. So 28,800 you spend right now. Customers pay everything after 30 days. So 480 into 100, 48,000, right? Produced next set of units. So this is cash flow. So you can compute NPV. You're spending 5250 right now, and you're going to get 25 grand minus 5250, and your required rate of return is 1%. So you get net present value of $19 million, okay, or $1.9 million. NPV in the second case is 28,000 you're spending right now, plus 48,000 you get from consumers, and 28,800 you spend to produce it. So 1.89 million. So by switching, you will be losing $78,000. So it is not ideal to switch it. So you shouldn't make the switch, because you will lose too many customers, even though your remaining customers will be paying full price. The valuation principle helps us weigh this trade-off. The present value of cost outweighs the present value of benefit, so the decision is not a good one. Okay, so next is monitoring account receivable. So you need to keep on monitoring whether the customers are paying on time, who is on default, who is taking more time to pay. So this monitoring has to happen continuously. Now how do you do that? You do it by two methods. You either compute account receivable days and compare it with past years to see how you're performing vis-a-vis last year. So how do you do that? The average number of days it takes. So account receivable days we have discussed how to compute. So compute that and compare it with average. So average number of days it takes the firm to collect from it sales. So you compute it and then compare it vis-a-vis different years to see how you're performing. Next is creating an aging schedule, right? How to do that? Categorizes account by number of days they have been on the firm's book. Can be prepared either using number of accounts or dollar amount of the account receivable there, account receivable outstanding. So this is the second way. You create a aging schedule. We'll see how to do that. And then you see which accounts means what is the percentage of accounts that are paying late and what is the percentage of accounts that is paying early. And if the percentage that is paying late is increasing, then you are worried. Then you also look at payment patterns, provide information on percentage of monthly sales that the firm collects each month after the sale happens. So let's see. So Financial Training Systems FTS bill, its accounts on terms of 310 net 30. So 3% discount if you pay within 10 days or you get a 30-day period. The firm's account receivables include 100,000 that have been outstanding for 10 days, 300,000 between these days, 20,000 between these days, 10,000 between these days, and 2,000 between these days. Okay. Prepare an aging schedule. So aging schedule shows the amount and percentage of account receivable outstanding for different length of period. With the available information, we can compute the aging schedule based on the dollar amount outstanding. How to do that? So this is given 1 to 10 days 100,000 is remaining, 11 to 30 300, 31 to 40 100, 41 to 50 20, 51 to 60 10, and 60 plus 2. So add them up and calculate percentage. How? 100 divided by 532, 300 divided by 532, 100 divided by 532, so on and so forth. Now you see your average means the credit period that you extended was 30 days, net 30 days. So most of the accounts are paid before 30 days. So you're good. But there are some accounts that take more time for them to pay. If this starts increasing, if the tail starts increasing, if people start defaulting and people take more than 50 days to pay, then you're worried. FTS does not have an excessive percentage outstanding at the long end of the table, that is the tail. Only 6% of their accounts receivables are more than 40 days. So it's not that bothersome. Determining account payable days outstanding. So we saw receivable management. Now we are going to payable management. Payable is suppliers. So determining the account payable days outstanding, the firm should monitor their account payable to ensure that they are making their payments at optimal time. So the crowd company has an average account payable balance of 250,000. Its average daily cost of goods sold is 14,000 and it receives a payment term of 215 net 40. Chooses to forego this discount, so they don't take this discount. Is the firm managing its account payable well? So what is the key point? If you're taking discount, you should pay at 15th day. If you're not taking discount, you have to pay at 40th day. So you have to delay the payment as much as possible. Either you take discount or you don't take discount. Now we will compute how many days it takes for this company to pay its suppliers on an average and then try to compare it. So the firm's balance and its daily COGS are given. So we can compute the average number of days it takes to pay its vendor by dividing the average balance by daily cost. Given the terms from its suppliers should either be paying on the 50th day or on the 40th day. There is no benefit of paying on any other time. So when does it actually pay? 250,000 divided by 14,000 gives you average account payable days, that is 17.9. So if it made payment 3 days earlier, it could take advantage of 2% discount. If for some reason it chooses to forego this discount, then it should pay at the end, that is extend this period from 17.9 to 40th day. The firm is not managing its account payable as well. The earlier it pays, the sooner the cash leaves the company. Thus, the only reason to pay before 40th day is to receive the discount by paying before 15th day. Paying on the 18th day not only misses the discount but costs the firm 22 days in terms of cash. So, stretching the account payable, when a firm ignores the payment due period and pays later. So, Ideally, when your suppliers are extending credit from you, it is beneficial to pay as much late as possible. But then suppliers may punish you by demanding cash on delivery or cash before delivery. So you have to be very careful about it. What is the effective annual cost of credit terms? 115 net 40 if the firm stretches the account payable to 60 days. So how would we do that? We'll compute the interest rate. We have done that, right? We'll compute the interest rate, effective annual rate, right? This Excel thing. We'll compute the effect cost of credit if it follows this cycle, and cost of credit if it extends it to 60 days. And let's see how much you can save.